everybody, this is Rob Keynes with the Freedom Report, and today we're going to roll over some economics, a little bit of cultural stuff all mixed into this episode. Reporting this about 11 a.m. Central Time as we record on October 15th, 2024. Welcome everybody to the program. Lots to talk about. This is sort of a catch-all episode. I'm gonna mix it up just a tad today, and how we're gonna do stuff. I'll probably be on the screen quite a bit, and we're just gonna roll through it. So, some of the sources I look at, in case you guys are wondering, we look at Market Watch for the economic calendar. There are lots of places you can get an economic calendar. If you've ever traded Forex, a lot of trading on the dollar or dollar pairs has to do with economic data. So especially non-farm payrolls, but other things as well. So definitely a lot of Forex sites have calendars as well. This just happens to be the one that I like. I wanted to go over just one or two things from last week. We already talked about inflation, but I want to go over consumer sentiment here at the bottom. This came out on Friday. Consumer sentiment fell, and that's just a sentiment indicator. It's how consumers feel, but they're feeling a little bit worse than last month. It went down from a 70.1 to a 68.9. So it had been high the last couple of months, or a little bit higher, inching higher, but consumers now are feeling a little bit worse than they had. Also wanted to point out this week this Tuesday morning, we had a negative 11.9 in the Empire State Manufacturing Survey. That's the northeastern part of the country, based out of New York. After it was a positive 11.5 the month before, that's been yo-yoing up and down for a couple months, and it basically just means there's not consistency in manufacturing. The rest of the manufacturing indexes are really weak as well. You notice yesterday on Columbus Day, we didn't have data because the markets were essentially closed. At least the bond market was closed. Not a lot of data is released there. A lot of the analytics aren't published. But we did have Fed Governor Christopher Waller speak. So I want to walk you through some things that he said. Waller skeptical of more big Fed rate cuts amid worries a strong economy could reignite inflation. Fastest U.S. growth in strong job markets means Fed should proceed with caution. Now, I've criticized a lot of government statistics. Last week, we spent a lot of time on the CPI. Coming up, and probably next week, I'll spend a lot of time on labor. I spent a little bit of time on labor force participation rate, but I'm actually going to go back to the book again that I wrote in 2009, and we're going to talk about how the labor statistic has basically been skewed off of reality. Just to kind of go over that again on the channel for those that are joining, that are new. But in any case, I don't think labor market is as rosy as they point. In fact, I know it's not. And I know the CPI numbers are vastly understated. So, but it just goes to show that the Fed governors aren't all in lockstep in terms of their decisions. There's a lot of dissent about, is the economy strong? Is it not strong? Are we looking at inflation, or are we focusing on labor? Is inflation good? Is labor good? Is it bad? The Fed doesn't even agree. So when the Fed makes policy decisions, it's not like this board of governors and the Fed chairman are all like, yeah, we're all 100% in agreement. We're at the point in the economy in 2024 in which the Fed's had a lot of back and forth and jawboning. If you read the meeting minutes and you listen to their comments every week about what's really going on in the economy. Let's listen to some of his comments. Federal Reserve Governor Chris Waller says the Fed should go slow in cutting interest rates. A Fed Gov Chris Waller said the economy is much stronger than previously thought, and the labor market remains quite healthy. He made his remarks at an event at Stanford University in California. Waller noted that the Fed and Wall Street have been fooled by reports over the summer that indicated the economy was slowing. Quote, to remind you of how bad the markets viewed the July data, some Fed watchers were calling for an emergency Fed meeting to discuss a rate cut, Waller said. The Fed stood pat in July and didn't cut rates until September. New and revised economic information instead is signaling that the economy may not be slowing as much as desired, Waller said. The economy could even put more upward pressure on inflation if growth accelerates too quickly because of lowered borrowing costs. So he's basically saying you could create a bubble if you continue to cut more. The economy is stronger than we think. Now, I would debunk that and say the economy is worse than we think. A lot of recession indicators are pointing out that we're already in a recession, and it's the janky numbers from the government that's leading people to believe it's stronger than it is. And I think Waller's being fooled here. But the whole point is not whether Waller is correct or not, or if the numbers are correct or not. The point is that given the janky numbers and given the differences of opinion of where we are in this cycle in the economy, the Fed's not in unison. And as I pointed out last week, they don't often know what to do, and they're reactionary. A lot of their decisions drive what goes on in the economy, and then they react to that by changing that decision. It's this big seesaw you get on with the Fed. The Fed is the big seesaw. All right, looking at the cryptocurrency market, I like S&P Global's view here because it kind of break it up into different chunks. You've got different charts here. One is a cryptocurrency large cap. It's the big ones. Then you got your broad digital market one. You've got your specifically to Bitcoin over here. your Ethereum index, X large cap, so the non-large caps. Overall, I wanted to show that the cryptocurrencies have been doing really well. Now, they did peak dating back some months ago, but they're still up this year. This is a 12, these are all 12 months. So they did peak around March of April, and over the summer they fell a little bit, and they've been rising a little bit, as you can see on these charts, pretty much across the sector for the last month to 2 months. So cryptocurrency, I think Bitcoin yesterday was up, was it 3,500? I did a Twitter post on that. Now it's down about 500. So they're seesawing back and forth, but you definitely see as the tech market goes, so goes the cryptocurrency. So cryptocurrencies are really tied to tech. They're tied to tech probably more than the dollar. Now they are affected by money printing, but they're not as affected by that as much as like gold is or other commodities. It's more in line with the tech stocks because they're still seen as a technical phenomenon, they're not seen as money yet. And so just kind of wanted to point that out. Over the cryptocurrencies are doing well. The big question is, will the cryptocurrencies fall if we get a big pullback in a recession and the NASDAQ starts to fall? I think that's probably been the case. And so if you're holding cryptocurrency, your choice really is, do I hold it? Do I sell it? What do I do? Typically, like in a 4-year cycle, you would look at next spring maybe, but I'm not so sure they'll last that long. We may have a little bit of a disruption that people at crypto experts can comment down there. And again, I'm commenting on cryptocurrencies because we cover the broad economy in this report. We have our gold, silver one on Thursday. I'm not covering Bitcoin as a money replacement. I'm covering as an investment class. And the cryptocurrencies are definitely investment class, and are definitely highly correlated to the tech sector, being basically a tech creation. So we're definitely going to cover them. Overall, they've been doing better this year, although not quite as consistently as gold, not really money, but they're basically tracking the tech indices. A little bit of a cultural note here, per the Epic Health. Back in California, mask mandates set to return in several California areas. What we know, mask mandates will be returning in several Bay Area locations. A lot of it is just for health workers and hospitals and places like that. But some of these city and county ordinances, city and county ordinances are basically geared toward anybody entering a health facility or being anywhere around it, maybe even some other public places. So some places in California are redoing this. Now, why are they doing it? I didn't get all the way down in the article, but there has been some reports of resurgence of some viruses and things, whether that's COVID related or not. There's been some data on that, and definitely California is doing that. The question is, are masks effective? There was something that came out in a medical report recently that the masks didn't. Oh, I'm sorry, it was on the East Coast with all of the, and in Wyoming with the fires, that the mask didn't block small particles. So if you were inhaling like small particles through a fire or through the result of a hurricane, health officials are saying that didn't really help. But yet, here we see people going back and doing that for health reasons. Does it help? I don't know. I'm not trying to create a firestorm with that report, just letting you know what's going on. Because again, it affects culture. We know when we were wearing the mask, it could affect our ability to relate to one another, how we relate to each other in culture. And I don't know if that's coming back again, but just wanted you to be aware. All right, on to Zero Hedge article. We're going to get in a lot of heavier economic stuff, economic stories here for the next few minutes. Boeing, desperate for liquidity, files 25 billion shelf registration. I'll get into what that is in a minute. It says here in this article, Boeing hasn't been profitable since about 2018. And we know that Boeing workers are currently on strike. There's a big strike union thing going on, and they're renegotiating. Just days after Boeing announced plans to cut 10% of its workforce, according to the story, due to intensifying financial pressure, such as dwindling cash reserves and mounting risk of a credit downgrade, as well as a drawn-out strike, the beleaguered plane maker filed a 25 billion shelf registration on Tuesday morning. Quote, the universal shelf registration provides flexibility for the company to seek a variety of capital options as needed to support the company's balance sheet over a 3-year period, Boeing wrote in the filing. Separately, Boeing already entered into a $10 billion supplemental credit agreement with a consortium of lenders. It is noted that the credit facility provides additional short-term access to liquidity as we navigate through a challenging environment. Sources familiar with the situation told the Wall Street Journal that Boeing is expected to pursue a stock offering of about $10 billion. So Boeing is in trouble. They haven't made a lot of cash. They had the plane issues, and now they're having a strike. It's not good for one of the largest plane manufacturers in the world. And again, a lot of this is driven by the macro. Some of it was the fault of Boeing in terms of the quality of the planes they were putting out, but a lot of it's also driven by macro. And it's a sign that the macro economy is not very good. Boeing's now going into an additional debt cycle while also having to renegotiate costs at the same time, probably rising costs due to any updated union agreements that they make. The outlook for Boeing over the next couple of years is not terribly great. Could Boeing recover from this? They sure could. They're going to need growth. But if we don't get into growth and we're in recession, like I think that we are, and the data indicates that we are, Boeing's really going to have to cost cut. So you can probably look at a lot of layoffs coming. They cut 10% of its workforce already. They're probably going to cut more. And it's just going to be a little bit of rough sledding ahead for Boeing and for its employees and for its shareholders. On to CNBC, Walgreens says it will close 1,200 stores by 2027 as earnings top estimate. So earnings are up, but they're still looking at the medium to long term, saying this doesn't look good in the economy. We need to close 1,200 stores. So according to the CNBC article, Walgreens reported fiscal fourth quarter sales and profit that beat Wall Street's expectations, reflecting the company's efforts to slash costs. So they're making money because they're slashing costs, not because they're growing their top or bottom line revenue or net income numbers. The retail drugstore chain also said it plans to close roughly 1,200 stores over the next 3 years, which includes 500 closures in fiscal 2025 alone. The results cap a rocky fiscal 2024 for Walgreens, which is grappling with pharmacy reimbursement pressure, softer consumer spending, and challenges related to its push into primary care. So Walgreens is trying to get into primary care and expand beyond just being that retail and pharmacy store concept. That didn't work out too well. Consumers aren't buying as much at Walgreens, and pharmacy reimbursement pressure. They're not getting all the money back from the insurance companies. I assume that's what that means for what they sell at their pharmacy. So part of it is just what kind of end up becoming bad account debt or bad debt from money that drugs that they're giving out, not getting paid for it through that system. And of course, the consumer can't spend as much. And so this is kind of a little bit of a spiral going on in the pharmacy sector. So we've seen some issues in the airline sector. Now we see some issues in the pharmacy sector. We're going to see continue in retail, and we're going to see in the 7-Eleven story in a minute more continued pressure on 7-Eleven and the retail side. Again, the theme of this video is going to be how soft it's gotten in retail because consumers just don't have a lot of money. We saw the consumer sentiment going down, and we also see layoffs in the retail sector and cost-cutting measures in the retail sector as a result. It says here the retail drugstore also plans to close 1,200 stores over the next 3 years. That immediately accretive to its adjusted earnings and free cash flow, meaning they're trying to free up cash flow to deal with what they see as non-coming recession. That's reading between the lines. They know it's about to get rough. They have around 8,700 locations, a quarter of which are unprofitable. So a quarter of these, about, I guess, 2,000 some locations, about 2,200, aren't making money. So they're already starting to close them out. That's a good thing for Walgreens to do, but it also means they're not in expansion phase anymore. You remember when you used to have the neighborhood drugstore, and that went into the big drugstore concept, and these chains becoming also primary care providers and providing groceries and all that kind of stuff. Now that's shrinking again. And so maybe it was overbuilt. Maybe between CVS and Walgreens and all of those types of stores, that concept was overbuilt. And now you're getting into the retraction. That if you're an investor, it's good to kind of look at what the trends are in society to see, have we overbuilt our pharmacy store concept? Are they trying to get into other things that aren't their core business? And then they have to back out of that because, well, they spent all that money and it's not bringing a return because people aren't, buying that stuff. And we're starting to get into a recession. So we got to clean out all the bad stores, got to clean out all the bad debt of all the corporate books. I've been talking about bad debt coming in corporate America for about 7-8 years. I've been writing on Seeking Alpha and doing social media. I knew the bad debt eventually gets so bad in corporate that they would have to cost cut. And this is exactly what's happening. Let's move on. 7-Eleven, as of USA Today, more than 400 7-Eleven stores to close by the end of the year. Closing 400 of its underperforming stores. The 444 stores to close are among 13,000 stores the convenience chain has in the U.S. and Canada. A list of stores to close was not released by the company, which announced the plan to shutter the stores during its most recent earnings call late last week. The closures are expected to happen in the fourth quarter of this year. The company said traffic and sales were challenged as consumers pulled back due to inflationary pressure, and also industry-wide that consumer cigarette sales continue to decline. Again, consumer. We go back to the economic data. What was down last week? It was consumer sentiment. Let me get down to it. Consumer sentiment had fallen, right? Even though Waller thinks the economy is great, the consumer numbers aren't good. So who's right, the Fed or are all of these stories right? Boeing, Walgreens, 7-Eleven. Let's look at the commodity index and go back to investments here for a moment. Then we're going to talk about China. The commodity index is actually down 7.63%. Just a broad index of commodities, the S&P Global Index, year over year, one full year. Over a 10-year period, it's actually up quite a bit, especially after the pandemic and even before the pandemic in 2020. commodities went up. So we did have a little bit of a boom in commodities. We peaked around 2022, about the middle of 2022, and then they started to come down. A lot of the current economic problems we had started in about 2022. We had that initial surge back when we reopened the economies worldwide, and then it peaked sometime about mid-2022, and the rest of the economy started to fall. A lot of the economic data we've been talking about not being as rosy or as good started about the same time the commodity index fell. I do think we're in a long-term commodities bull market, but I do think we're in a short-term pullback because of deflationary pressures. The reason I bring this up, when commodities aren't doing well, a lot of times you're having deflationary pressures, less demand for commodities. Sometimes it's money printing and people investing in other things. They're not investing in the commodities complex because they're in stocks and bonds. But now I think this is more a result of reduced consumer demand because we're seeing these consumer numbers over and over and over, and that's pointing to the picture of people buying less. Well, you need less commodities when people are buying less, and it's not just the U.S. As we're going to see, it's also in the second largest global economy. Let's talk about China. We'll get to the military drills here in a minute. Oh, one more. AutoZone in the U.S., significant exposure to struggling working poor consumers. AutoZone is lowering their fiscal 25-year estimates, reflecting their outlook for muted growth in the next few quarters. Another retail issue. Okay, now on to China. I reported yesterday on Twitter that China is going to print 6 trillion yuan, about 281 billion US, to help local governments, local economies. Now, what they do in China is they have on-book debt and off-book debt. So they are hiding some of their debt. It's known, but it's off-book. So what they're doing, a lot of this is to pay their off-book debts. So some of the risks that these local economies took that they didn't put in their numbers, which is why you have to be careful believing any government numbers, they're now paying off with a 6 trillion in stimulus. And as we'll see here in an article, they need a lot more if they're going to go back to what they did in 2015. But it was interesting to see that China is basically doing the same thing. A really good article here at Zero Hedge is talking about stocks right now and the mess that is China. So the largest economy in the world, US, is not doing great. We just went over those numbers, and we've been going over those. And again, since 2022, we've had a general downturn in the US economy. Stocks have been doing well, but the bonds started to have issues. Even the commodities started to have issues. We started seeing higher inflation, all that kind of stuff. So I think we've had that downturn since 2022. I think we're in a recession. I'm just going to call it, even though the gamified US numbers aren't showing it. China also is in recession. So that's an indication this deflation is not going to just be in the US. It's not just going to be in the Western world. We know Europe is suffering too, UK. It's in China, the world's second largest economy. Listen to this. China would be unable to recreate previous reflationary episodes simply because Beijing would not be able to recreate the credit impulse explosion that rebooted the Chinese economy during previous downturns in 2020, 12, 2015, and 2020. That's what the article is saying. In the 2015 stimulus cycle, China's credit impulse peaked at 13.5 trillion yuan. That's more than double what they have said this week that they're going to issue. And that's based on the old GDP number. So as a percentage of GDP, what they said they're doing yesterday is much smaller. And Zero Hedge is basically saying, we've been claiming this for a while. It peaked at 13.5 trillion yuan back in 2015. That was the height of the China stimulus 2015 so far as a measure to GDP. How much they're producing, how much are you stimulating? It peaked in 2015. It's been downhill ever since then. Given that China's nominal economy is now twice as large, an equivalent stimulus would need a credit impulse to peak at 27 trillion yuan. We know they're not doing 27. They're only doing the 6. So they're not completely reflating the economy. They're just trying to provide some assistance in dealing with some of this excess debt and the local economies that they've had that have been hiding off book. At its most recent peak, China's credit impulse did not reach even 5 trillion yuan, meaning that to compare to the 2015 episode, the just announced stimulus cycle would need to an amplitude 5 times greater than the most recent peak, meaning you would need a 5 times more stimulus in the Chinese economy than you had in 2015 to keep it going again. What have we been talking about? The debt-based fiat monetary system. When you get to the end of the system, you have to print so much money to get the economy to move a little bit. I said last week, for the U.S., it's like $1.9 to create of money printing and debt easing, by the Fed to get $1 of GDP increase. China's at that point too, where they're going to have to print many more dollars and issue more easing conditions, easy debt, free money or almost free money to get any growth in GDP, and that their economy, or their economic cycle in terms of their ability to stimulate it peaked in 2015. So China's been on a downward trend for about 9 years. The US is now on a downward trend. We see Europe on a downward trend. We see a lot of countries on a downward trend. We've seen issues in South America. We've seen issues across the globe. We're going through a global deflationary cycle. That's what's going on. That's why it's not going to be a quickie. This isn't going to be a quickie recession. It's going to be a long and protracted one because the entire world's in the same boat. Too much debt, too much money printed, not enough emphasis on building infrastructure, not enough emphasis on keeping things tight financially. You got to get rid of all that crap, and everybody's going to be doing it at once. So there's nobody other than like space aliens from another planet that could bail us out at this point. We can't just print more money. You know, we're in an enclosed system here on Earth, and unless something happens where we get something like free energy or something to help us deal with all of that debt and excess money printing, we're going to have to go through a big nasty recession. So China credit impulse is a share of GDP. I wanted to show that one. It's been draining or falling since 2009. So 2009, after the last great recession, it was 25%. Then in 2013, they did 15. Then in 2015, 2017, they did 15. Then, you know, during the pandemic, they did 10. And this time it's 3. So they're just not doing as much. So the credit impulse has gone down, as so as a nominal GDP, as you can see in this bottom chart. Nominal GDP down, credit impulse down. And you'll notice that when they print the credit impulse, the GDP goes up after. So the GDP in China, just like the US, is created just by printing money and having easy loan terms. When you do that and you just shove fake money into the economy, it causes it to grow. But over time, when you do that so much, it becomes saturated and you can't get that same amount that you did before. And that's why they said it had to be amplified 5 times what you did in 2015, because it's just not going to work this time. Anyway, more detail on that Zero Hedge article. Last thing I want to say about China. As comes economic problems, come war. This has been a theme I've talked about a lot. China conducts military drills around Taiwan in mourning to island's president. The PLA and Chinese Coast Guard approach Taiwan by sea and air in a move linked by state media to separatist National Day speech. And this is basically what they're doing. They're doing exercise areas around Taiwan. It's long been postulated that China wants the Taiwanese economy. They want their chip production. They believe that Taiwan should be a part of China. That in the next global conflict, whenever that comes, China will likely make a move for Taiwan. A lot of military analysts around the world have said that. This is not new in this article in The Guardian, but they're showing they're actually running drills now. So remember, as the economy wars, so too, as the economy goes, so too does war. And generally, when things aren't good, the missiles and the guns come out. Now, what will that result in? I don't know at this point, but we're starting to see it. We're starting to see world economies eyeing different prizes across the globe. Ooh, if I could get that, that would help us. Ooh, if I could get that, that would help us. And the great empires around the world, the great economies, are looking at where can we get additional resources. And a lot of times that manifests in military or hot conflict. It's not just the soft conflict of the money game and politics and culture. There's the hard conflict, and we're getting into an area of more hard conflict. Of course, we've seen the various regional wars around the world the last year and a half. That's going to do it for today's report. Thursday, we got the gold and silver report. On the backs of the economic report, we'll talk about what gold and silver are doing, what it means in relation to all the information I just gave you. This one's running about 23 minutes. That should be long enough. Thank you guys for joining. God bless all of you. Love you guys, and see you on Thursday. Rob Keents with the Freedom Report.